Hello, everyone, and welcome back to Financial Podcast. I'm Olivia, and today we're diving deep into a topic that's been making significant waves across global financial markets. The recent stark warnings from the Organization for Economic Cooperation and Development, or OECD, regarding the widespread economic impact of Donald Trump's U.S. tariffs. The picture they paint for global growth is certainly a concerning one, suggesting a difficult period ahead for economies worldwide. The OECD, a leading international policy group based in Paris, has recently delivered a sobering assessment of the global economic outlook. Their latest forecasts indicate a noticeable slowdown in worldwide growth, now expected to reach a modest 2.9% this year, a downward revision from their previous projection of 3.1%. This revised projection for 2.9% global GDP growth is anticipated to extend into 2026 as well, indicating a sustained period of reduced economic dynamism. What's particularly striking and underscores the breadth of this concern is the OECD's clear message that weakened economic prospects will be felt around the world, with almost no exception. This isn't just about a few isolated regions or specific sectors. It's a comprehensive global phenomenon that highlights the interconnectedness of economies. Alvaro Pereira, the OECD's chief economist, put it quite plainly in an interview, stating that they are forecasting basically a downgrade for almost everybody. He further elaborated that this translates directly into a lot less growth and job creation than we had forecasted in the past, impacting livelihoods and prosperity on a global scale, reducing the opportunities that would otherwise be available. The primary culprit for this significant downgrade, according to the OECD, is a substantial increase in trade barriers. This is explicitly linked to Donald Trump's U.S. tariff policies, which have been implemented since his return to the White House and have targeted a long list of countries. The unpredictable approach to implementing these measures has, in itself, created widespread uncertainty, making it exceedingly difficult for businesses and nations to plan effectively for the future, leading to hesitation and a chilling effect on investment. Now, let's turn our focus to the United States, which the OECD identifies as being among the hardest hit by these policies. The outlook for the U.S. economy this year has been sharply cut from an earlier projection of 2.2% down to a mere 1.6%. This significant slowdown is projected to continue into 2026, with growth further decelerating to 1.5%. To put this in stark perspective, this represents a marked departure from the robust 2.8% growth that the U.S. recorded in 2024, signaling a considerable loss of economic momentum and a dampening of its previously strong performance. The OECD directly attributes this anticipated slowdown to the substantial increase in the U.S. effective tariff rate on imports, compounded by the inevitable retaliatory actions from various trading partners around the globe. It's crucial to understand what this effective tariff rate actually signifies, as it highlights the direct financial impact of these policies on the flow of goods into the country. The OECD reports that the U.S. effective tariff rate on merchandise imports has soared to 15.4% by mid-May. This is a truly dramatic increase from just over 2% in 2024, and remarkably, it's the highest rate recorded since 1938. For historical context, 1938 was a period immediately following the Great Depression, where the Smoot-Hawley Tariff Act had been enacted, significantly raising tariffs on imported goods in a failed attempt to protect domestic industries. The OECD's explicit drawing of this historical parallel underscores the potential severity and the lessons from past protectionist policies that led to global trade contraction, deepening economic woes rather than alleviating them. Furthermore, the OECD warns that the U.S. is at risk from rising inflation. This presents a direct contradiction to statements made during the presidential campaign that inflation would fall. The forecast for annual headline inflation in the U.S. is now set to pick up to 3.9% by the end of 2025 due to higher import prices. This projected rate is nearly double the Federal Reserve's target rate, signaling potential challenges for monetary policy and household purchasing power as everyday goods become more expensive for the average consumer. Other significant contributing factors to the U.S. slowdown cited by the OECD include high economic policy uncertainty, a significant slowdown in net immigration, which impacts the labor supply, and a sizable reduction in the federal workforce. Moreover, it's worth noting that recent official data actually showed the U.S. economy shrank at an annual rate of 0.2% in the first 3 months of this year, marking the first contraction since 2022. This official data directly challenges claims by Donald Trump on social media, where he had stated, "Because of tariffs, our economy is booming." The divergence between political rhetoric and economic reality, as presented by the OECD, is quite stark, emphasizing the severity of the situation. So, how exactly do these tariffs and the escalating trade tensions translate into such significant economic headwinds? The mechanisms are multifaceted and deeply interconnected. Firstly, substantial increases in trade barriers inherently lead to higher trade costs. These additional costs are ultimately passed on, burdening consumers through higher prices for goods and impacting American manufacturers who rely on imported raw materials and components for their production processes. While the OECD does note that this inflationary impact might be partially offset by weaker commodity prices, the overall trend firmly points towards persistent upward pressure on prices, creating a challenging environment for household budgets. Secondly, the heightened policy uncertainty resulting from frequent and often swift changes in trade barriers significantly dampens both business and consumer confidence. This pervasive uncertainty, often characterized by the unpredictability of Trump's approach, is expected to hold back crucial business investment. Companies become naturally hesitant to commit to long-term plans, such as expanding operations or investing in new equipment, when the rules of global trade are in flux. The OECD explicitly fears that further increases or rapid shifts in trade barriers could intensify the growth slowdown and trigger significant disruptions in cross-border supply chains, which are the intricate networks that facilitate global manufacturing and distribution, making it harder and more expensive to move goods. The ripple effect is also keenly felt in financial markets. The possibility of tariffs pushing up inflation expectations could lead to central banks responding with higher interest rates, which in turn would further slow economic growth. In fact, we've already seen European stock markets dipping in response to the OECD's growth downgrade and weak factory data from China, with mining companies among the fallers due to fears of reduced demand for commodities. The scope of this disruption is vast, with the OECD indicating that trade equivalent to over 2% of world GDP is now directly facing higher tariffs, suggesting a much greater and more widespread impact than the U.S.-China trade tensions seen in 2018-2019. The effects are indeed global and extend beyond the U.S. In China, which has faced significant U.S. tariffs, including periods of triple-digit levies that were temporarily eased, the OECD has trimmed its growth forecast slightly from 4.8% to 4.7% for 2025. Chinese exporters are clearly being hurt by these tariffs, further hobbling an economy already grappling with the structural challenges of its real estate market collapse. Recent manufacturing data from China paints a clear picture. Activity in May shrank at its fastest pace in 2.5 years, driven by a significant fall in new orders and weaker export demand. The Caixin and S&P Global Manufacturing Purchasing Managers Index, a key indicator, fell to 48.3 in May, a reading below 50, which indicates contraction, and the lowest since September 2022. One analyst even vividly described the slump as a canary in the trade war coal mine, with its feathers scorched by tariffs and global uncertainty, highlighting the immediate and severe impact on their export-oriented businesses. To counter some of this damage, Beijing has outlined plans to cut interest rates, encourage bank lending, and allocate more money for factory upgrades and elder care. Across the Atlantic, the United Kingdom is also expected to experience a slump, with the OECD downgrading its growth forecast specifically due to the damage caused by Trump's tariff war. UK GDP growth is now projected to be 1.3% in 2025, before slowing further to just 1% in 2026. This is compounded by constraints on Whitehall spending and higher than expected inflation. Even Japan's growth outlook has been revised down from 1.1% to 0.7%. The European Union, for its part, has already reacted to Trump's threats of doubling steel duties to 50%, with an EU spokesperson stating that the bloc was, quote, prepared to impose countermeasures, hinting at further escalation of trade tensions and a potential tit-for-tat cycle. The Eurozone, however, appears to be a notable outlier in these downward revisions, with its forecast remaining steady at 1% growth for 2025. This relatively stable outlook is partly helped by anticipated interest rate cuts from the European Central Bank and recent data showing Eurozone inflation falling to 1.9% in May, below the ECB's 2% target, largely driven by cheaper energy prices. This easing of inflation is seen as good news for households and may pave the way for further monetary policy easing, offering a glimpse of a different economic path. The message from the OECD is unequivocally clear and urgent. As Alvaro Pereira highlighted in his interview, for everyone, including the United States, the best option is that countries sit down and get an agreement. He further emphasized that avoiding further trade fragmentation is absolutely key in the next few months and years, stressing the critical need for collaborative solutions over unilateral actions. There is a palpable and growing risk that protectionism and trade policy uncertainty will increase even further, leading to the introduction of additional trade barriers beyond what we've already seen. The OECD's own simulations grimly illustrate that such additional tariffs would only serve to further reduce global growth prospects and fuel inflation, dampening the global economy even more. However, there is a crucial silver lining should policymakers choose to pursue it. The OECD explicitly adds that a reversal of the increase in trade barriers, essentially a de-escalation of trade wars, would significantly support growth and simultaneously help to reduce inflation worldwide. This highlights the immense power of informed and cooperative policy decisions in shaping our future economy. The current trajectory, driven by escalating trade wars and pervasive tariff uncertainty, presents substantial and undeniable headwinds for global prosperity and job creation. Understanding these complex dynamics and the deep interconnectedness of global economies is paramount for navigating the financial landscape ahead, allowing us to make informed decisions for our own financial well-being. That's all for today's deep dive into the OECD's latest warnings and their profound implications for the global economy. Thank you for tuning in to Financial Podcast. I'm Olivia, and I look forward to bringing you more insights next time. Stay informed, and remember, in these uncertain times, making sound financial decisions is more crucial than ever. Goodbye for now.